Good morning. Welcome to Market Monday, our final Market Monday for 2022. We hope you had a nice Christmas and Hanukkah and are set to ring in the new year. 2022 has been a year of extremes. We use superlative words like most, least, highest, lowest, countless times throughout the year. And while getting through these extremes has been easier said than done, there's not really any other choice. As we talked about a couple weeks ago, markets cycle. It's a feature, not a bug. And we just have to deal with it the best we can and sustain to see through to the other side. So let's get into what's top of mind heading into the new year. First, let's have a look at 2023 year-end forecasts for the S&P 500. As a reminder, at the time of this recording, the S&P 500 index is around 3865. Here are the forecasts listed from highest to lowest. We can see Deutsche Bank coming in at the highest at 4,500, representing a 16.5% gain from today's levels. Going down a few, we have a couple here at 4,200, including JP Morgan and Wells Fargo. That's about an 8.67% gain from current levels. 4,000 seems to be a pretty popular level with four banks there. Then we have Morgan Stanley and UBS essentially ending next year flat compared to today's levels. And it looks like the French banks are the most bearish at about 5.5% and 12% losses from current levels at the end of 2023. So from a 12% further drawdown to a 16.5% gain, that's what Wall Street is expecting next year. But forecasts are a curious thing. Here's what Wall Street forecasted for year-end 2022. The S&P 500 price at that time was around 4,700. Most were expecting gains. Oppenheimer was the most bullish at 5,330, a few modestly positive but mainly flattish forecasts, and a couple bears in there. But we're more than 12% below even the most bearish Wall Street forecast for year-end 2022. Look, we all want to know what will happen, to know the unknown and the unknowable. It's in our human nature, but unfortunately the unknown future is a fundamental part of investing. And we're honored to be your partner in navigating together whatever 2023 will bring. As dizzying as 2022 has been, and as extreme as the last 3 years have been since COVID shocked the world, we believe 2023 will be about finding balance. If 2022 was about recognizing imbalances that had built in the economy and starting to address them, we believe 2023 will be about setting ourselves up for what comes next as the economy and markets find their way back to steadier ground. Even if the adjustment period continues, the disruptions may not be fully resolved and there may be more challenges to come, but progress toward finding balance is well underway. Let's get into some specifics, starting with the R word, recession. Fed Chair Powell said in no uncertain terms, fighting inflation would be painful. So a dip into recession would not at all be surprising, especially armed with a cushion to lower rates and financial plumbing ready to go at a moment's notice. We don't expect anything close to a 2008 style recession, which brought the entire financial system to the brink of collapse. Keep in mind the 3 Ds of recession: depth, diffusion, and duration. Depth being how deep or how far does the economic activity fall. Diffusion refers to how widespread it is across various sectors of the economy. And duration is how long does it last. The COVID recession was only 2 months, whereas the average recession typically lasts 10 months. Something else we've discussed many times here this year are LEIs, leading economic indicators. Look at this. Further into recession territory, even though investors are tempted to say, this time is different, we all can take note of general principles about business cycles and the markets. Housing has been leading the extremes over the past few years, from the short-lived COVID bust to the post-COVID boom to what appears to be a housing market looking for balance. Housing plays a significant role in consumer spending, and investors should monitor the housing market as a bellwether for the health of the consumer. Consumers spend roughly 34% of their total spending on housing, so a decline in housing-related costs should give consumers more for discretionary spending. Housing also plays a crucial role in inflation. Just last week, we talked about the housing being about a third of inflation and a huge part of the sticky services inflation. Almost on cue, just last week on December 19th, researchers at the BLS, the organization that calculates CPI inflation, and the Cleveland Fed branch released a brand new data series called New Tenant Repeat Rent Index, a new way of tracking housing inflation. Were they listening to the Market Monday? If you recall, the main point was that the traditional way CPI calculates housing inflation is on a significant lag. But this new data series measures rental turnover as it happens, not when outdated surveys happen. Without getting into the weeds, we can see here the red line is traditional CPI rent, which we looked at in depth last week, and the yellow line is the new data series. So whereas traditional rent CPI is still heading higher, the new data series clearly peaked and is already heading lower. While this just restates what we've been talking about for a while now, it's nice to see that official institutions giving credence to this very important distinction. Turning to the stock market, 2022 was more about the macro than the micro, meaning inflation and sharply higher interest rates caused a repricing in the stock market, rather than a deterioration in earnings causing the market to head lower. Next year, we expect that to shift, where earnings will come into the focus. We don't expect such a drastic shift as we saw this year from macro back to micro, but rather a market again looking for equilibrium as it balances inflation, rates, and Fed policy versus company fundamentals and profits. Looking back at 8 prior hiking cycles, here's how the S&P 500 stock market fared over the next 3 months, 6 months, and 1 year after the Fed stopped hiking. We can see that more often than not, the market finds its way higher, most of the time double digits higher. We should note that stocks struggled the most. 1981 and 2000 were both during recession. While a 2023 recession is a real possibility, we would expect this type of recession to be more mild than 81 or 2000. As mentioned last week, we believe the Fed will have enough ammo at its March 22nd meeting to pause further hikes. Another potential tailwind for stocks is that since 1950, during the 18 years the S&P 500 was down, the following year was up 15 out of 18 times. And 2 of those 3 years were during the dot-com crash in 2000 and 2001. As we mentioned earlier, the micro earnings will come more into focus next year. While earnings estimates are still high for next year in orange here, we expect them to continue trending lower as they have been since summer. Barring a severe global recession and an ensuing crash in the stock market, we believe earnings will hold up relatively well as inflation continues to normalize and we get more clarity regarding Fed policy. And just in case you hear it on the news, stock market earnings are generally stated in dollars of earnings per share. So just keep in mind the current level is around 220 of earnings per share. So any significant deviation in either direction will likely be accompanied by the stock market going in that same direction. And finally, turning to bonds. Core bonds have seen losses in 2022, unlike any year since the aggregate bond index's inception. Being down nearly 16% has wiped out nearly 5 years of index gains. But because bonds are both financial instruments and financial obligations, which pay coupons and principal repayments at par when they mature, The potential for recovery is a bit more certain than in the equity markets that rely primarily on price appreciation. So, how long will it take to recover this year's losses? Here are some expectations for various fixed income markets under different interest rate scenarios. If interest rates don't change at all, the best expectation for performance over the next year would be the index's starting yield, this dark blue highlighted section. Although if interest rates decline by 0.5%, the Bloomberg Aggregate Bond Index could return more than 9% over the next 12 months. Moreover, if interest rates move back into the low 3% range, the core bond index could return around 12% over the next year. Also, and importantly, given where starting yields are, if interest rates increase by another 1% from the current levels, fixed income markets broadly could still generate positive returns over the next 12 months. Given the move higher in yields we've experienced this year, we think the risk reward for owning core bonds has improved. Even for investors that don't want to take a lot of interest rate risk, the opportunity set in shorter maturity fixed income securities has improved very well. With 1- and 2-year Treasury securities both yielding above 4%, cash and cash-like instruments finally offer an attractive yield. The caveat being if interest rates do decline over that time frame, that investor would need to reinvest potentially at lower rates. To wrap for this week and for 2022, we believe next year will be about staying balanced in order to stay the course. 2022 was filled with so many extremes and uncertainties that it would be reasonable to feel a little shaken up. While we can't know exactly when the turbulence will end, the economy and the markets have already made meaningful progress toward rebalancing, a process we expect will continue throughout next year. While we have one eye on the risks that lie ahead, the other eye is on identifying the opportunities, which will appear eventually. We look forward to our continued partnership with you in 2023. Take care and best wishes for a happy new year.